have been hiding out in treasuries, as you know. As those yields fall, that is a classic sign that the fear trade is in. People are piling into U.S. treasuries because they seem to be the safest bet yet. The 10-year reaching a near 4-year low on Friday. And when I say the 10-year, I mean the 10-year yield. So how is the bond king of all kings betting? We are bringing in Janus Capital's Bill Gross. And Bill, right off the bat, stocks, of course, plummeting around the world. Thank you so much for coming here. You're never one to sit on the sidelines. Can you narrow down the focus a bit and tell us exactly what looks good to you at the moment, what's safest, and what has the best yield?
Well, almost all developed market bonds have no yield, which is part of the problem, Liz. You know, $10 trillion worth of bonds, Germany, et cetera, you know, are yielding in negative space. And U.S. Treasuries, yes, they're relatively attractive compared to the others, but, you know, there's risk now, not just in stocks and equity and risk assets, but there's risk in high-quality bonds because yields are simply too low. I would suggest, you know, a temporary vacation as opposed to rushing out to buying Treasury bonds and hoping that they go up in price, because that, I think, is limited.
Well, look, we already had the S&P ratings agency downgrade the UK from AAA to AA. I'm not sure that's such a market event. We were down about this much before that happened. But the Federal Reserve, are any tightenings, any rate hikes all but erased for 2016, Bill?
Yes, I think, you know, certainly for 2016. I mean, this, from 30,000 feet, Liz, this is the end of globalization as we've known it, not the end of globalization. But as we've known it, and what does that mean? It means that trade policies, it means that immigration policies, it means that, you know, growth, which is reflected positively by those free policies and has been for the past 20 or 30 years, is at risk. And that's why markets are going down. They're going down because growth is being threatened. And what does that mean? Does that mean potentially a recession in the United States? You know, I think perhaps. I don't know what the odds would be now, but 30, 40, 50% chance of recession, if only because the dollar is so strong and our ability to manufacture goods and to export them now are at risk, and profits as well. So, you know, it's fair to say that this is a micro event on a small island the size of Wisconsin, but it's really a global phenomenon that reflects the future of free trade and the future of immigration, which in turn are reflective of slower economic growth.
Listen, you're the second person in the last about 30 minutes to say, look, it is a small island and we love the perspective. But Cyprus was a small island, and, you know, any kind of banking crisis on Cyprus certainly roiled the markets. I really do appreciate that calming perspective, Bill, but do you see any kind of derivative-like event or like a long-term capital management disaster from 1998 where you had the ruble roiling the world? Do you see anything like that at all related to this? Because I'd like to believe we're through this black swan moment. I just want to hear from you.
Well, I think we are for the most part, and let's be fair. Banks are better capitalized. You know, the world in terms of interest rates and interest cover, you know, it is in much better shape than it was pre-Lehman. And so, you know, the potential for a moment, like a Lehman moment, it is certainly lessened. But it is fair to say that the markets are globalized now, and to the extent that something happens in the UK or something happens in China or something happens in Japan, you know, it's going to affect markets on a global basis as hedge funds and traders and other institutions try to rebalance their portfolios. And that's, to some extent, what you're seeing now, in addition to the fact that growth itself on a global basis is coming down.
Yeah, but you've got the financial stocks, which tend to underpin the markets on the best of days. They really seem to be having trouble here. As you look ahead, how far, as people pile away from stocks and into the 10-year Treasury, how far does this 10-year yield go? How low does it go?
I think it has a chance to go to 1.25%. Is that a big deal?
Really?
It's probably 2 or 3% in terms of a capital gain, so it's not much. But it is reflective, not really of a normal market in the United States, but an abnormal market in the rest of the world. And to the extent that 10-year German bonds are trading at -10 or -15 basis points, then, you know, Japanese investors will look at the U.S. and say, well, that's attractive. And so, you know, it has the potential to go lower. I think ultimately these low yields are destructive for economic growth, but it is what it is. and it is a function of Federal Reserve and central bank policies that have been in place for 5, 6, 7 years.
Great to see you. Thank you so much, Bill. 1.25% on the 10-year yield is his call anytime. We do appreciate it.